Well, good evening and welcome to the live stream here on the 6th of January 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks very much for taking time out of your Tuesday evening to spend it with us. Really appreciate it. Interesting show this evening, I think, given the recent interventions from Trump in Venezuela and a few other things. So we're going to talk about some of those in the context of the markets and what we may be thinking there. As normal, of course, we're not going to provide specific financial advice. This is just a general conversation. No legal advice, general conversation only. We moderate the chat, but feel free to throw questions, comments in as we go. If you use that Walk the World DFA, you get my attention. And I can see your question coming in and get it on the show as appropriate. And also, I've enabled Super Chat, which means you can make a contribution to what we do around here, or indeed get your question to the top of the list. Really support all those. Really thank you all of those who support us via Super Chat or via Patreon or PayPal. Really helps to keep the show on the road. Thank you very much, as always. Right, let me bring Damien straight in. Damien, welcome back. How are you going?
Yeah, great. Thanks, Martin. Happy New Year.
Yeah, and to you too. I hope you had a good Christmas, New Year time, and I hope you managed to get some time off. But hey, we came back and bang, straight into some more world-shattering, earth-shattering things. And I thought we should chat briefly about the concept of imperialism, investing in an age of rising imperialism, which is what I called the show this evening. Because I think it's important, this concept of the sphere of influence. Trump coming out and saying, basically the Americas and that whole area, we're in charge of that, like it or not, that's our domain. But of course, there are consequences and implications. I'm thinking of what China might be reacting to. I'm thinking what Russia might be reacting to, thinking, well, if he could do it, why can't we do it? And I suppose the other side of it is, well, this is politics, but does it have an impact also on the markets? And does it mean that we should be thinking about investment strategies differently? The markets have been relatively positive so far, a little bit up, dollar not too far off, oil's not moved that much. So it's like, well, the market's saying, oh, well, we're not sure yet. But I don't know. So your immediate reaction, but also how do you think about this? How do you incorporate these world-shattering ideas into your investment strategies is the question I'd like to explore today.
Yeah, absolutely. And so I think there's a couple of different angles I want to approach this from. The first is, look, it's significant. It's a major changing of international norms. I think the US was looked upon as, while I think they've certainly done a lot of things that you would. You couldn't support everything they've done. I think there's a veneer at least of we're trying to do this for the right reason, and I think there's it didn't seem to come through certainly in the press conferences. It seemed to be more about there seemed to be more mentions of oil than they did of other things, and is the leader of a country, whether he won the election fairly or you don't want to support and you want to try and support him. He's obviously wasn't the there's not a shining light on the hill, but I think there's the questions now come is what's Russia's reaction going to be, what's China's reaction going to be, and as you said, if the US is basically saying yes, we're going to split this into hemispheres, if China decides it would like more of the South China Sea or it would like to grab a few islands from some of its neighbors, is that the same? Is that sort of going to the same thing? And obviously, Russia's already at war in the Ukraine. I doubt they want to open any new fronts, but you'd think that would certainly be hardening their resolve to stick with it. So it's significant in one sense, and the other sense, actually, it's not that significant if nothing eventuates from it. So if all we see is that, there's a little bit of moving around the edges, and as I spoke, China does a few things with some of the smaller local neighbors, and Russia does the same. Does that have an impact on the world economy? Look, probably not. The question is, can you get miscalculations? And absolutely, that's where the thing is that, I think Trump has certainly displayed a tendency in the past to say, to apply different standards to others as to what he might apply to himself or his own party. And so it might be that he decides that, if China does one of these, actually, no, you know what? That's enough for me to now step in and decide that, we do want to go to war with China over whatever it is. And so, so I think the heightened risks and from an investment perspective, we need to be aware of that, and we need to be sort of, I guess, not overreacting in terms of, because at any time there's always 1,000 things that can go wrong. And I think the danger people often run into is just going to cash whenever they're worried about something. Let's just go to cash. It might be a world war. Let me just go to cash and I'll wait it out. And in 5 years' time, you can find that you've been sitting on the sideline for 5 years. You've made nothing in cash, and meanwhile stock markets have sort of boomed along. I think it is telling as well. From an equity point of view, it's not the you'd like to think that he had the best interest of the Venezuelans at heart, but he spoke a lot about, he talked to all the US oil companies beforehand. Hadn't sort of gone to the Democrats to sort of tell them what he was up to, but he has spoken to the oil companies. And so it is just one more sign that, he is genuinely for profitability of companies. And probably, well, not probably, most likely, the profitability of companies is far more important than the economic outcomes of even his own supporters. And so I think you just need to take that in mind, that yes, look, I can be worried about events, I can be concerned about what's happening, but do I want to? Does that mean you go to cash for the period, or do you at least in some way stay invested with a view that, look, maybe some of these are maybe companies more generally are going to benefit from other things that he's doing.
Absolutely, and it's just worth saying. A couple of people are saying that the stream is pausing a bit. According to my readout here, it's doing fine. So it may be a local issue. I'm not sure, but nothing I can do from it. Otherwise, we'll have to continue. But we are making a recording, so we can always invite you to come and listen to the replay if, in fact, you can't get the stream to work. But it is working at the moment. Everything's working here. So, Damien, I guess the question is, when you try and think about it, you've got to sort of separate noise from signals. We've said several times. I thought Adam Crichton's comment was quite interesting. There never was a rules-based global order, right? So, this idea that there's a set of rules that everybody plays to it is perhaps a little bit of a question. And I thought this was quite a fun one too, when this cartoon came out, right, which reminds you of another one, right? So
yes,
depends on how you look at it. What you can say for sure is that looking at the oil reserves, you can see there that Venezuela's 3.3 billion, is big. Or another way of looking at it is here's the relative sort of Venezuela, Saudi Arabia, Iran, and you can see the others going off there. But of course, it's underdeveloped in Venezuela, underinvested for many years, and the truth is it's going to take a lot of time and effort to try and sort it all out. So it's not going to suddenly magically sort of change the world of oil overnight. But for me, what was really interesting was this idea of, we're going to run Venezuela. We've been talking to our oil friends and they're going to put massive investments in. So actually he spoke to his business partners rather than, for example, his political allies like the Eurozone or anybody else, right? He didn't want it to get out in case people didn't see that. So it's a really interesting question here. And to my mind, it also says, you got to understand that when Trump says, America first, he's quite serious about it. But his view of America first is more influence, more control, more power, and therefore Greenland, watch out. that's for next month. But it sort of highlights the fact that there is a series of questions being raised here. And so from an investment point of view, you're sitting with your superannuation, probably spread between Aussie and probably the US being the biggest market by far. The expectation, of course, is that generally in January, markets tend to go up. There's a little bit of a chart here, which I've got, which shows that if you look back over recent times, January's tended to do quite well in terms of the S&P 500 monthly or seasonal changing, right? It's one of the better months. But we've also got this issue of the big investments in AI and the asymmetric investments that are going on there. So does it change the weighting to US related investments, or is it not enough at the moment to move the dial?
Yeah, look, I think for me, it's not enough to move the dial in terms of my US versus China versus Europe, but we were already had a fair bit in Europe already, which has been a positive for us over the year, just because the US dollar was relatively weak, as well as Europe doing in a relative sense quite well. Now, so the problem is Europe is cheaper than the US still, so you can still sort of make that argument, but it's lower growth, and the growth that you're getting in the US is very and one more step though is it's lower growth, but it's more even growth. You're getting more consumer. It's more consumer led, and the household sector is doing better in Europe. So it sort of depends a little bit what you're investing in. The stuff that's doing really well in the US is all the AI stuff, and that's where this sort of breaks down. Is like, well, there's not that many companies in Europe that are worth investing in from that front. One of the big ones we do, was actually a bit of a. We used it in the middle of the year to get in ASML. It's a big Dutch company, and Trump was sort of targeting them in terms of, maybe I won't let you sell to China, and maybe I shouldn't let you do this, and maybe I shouldn't let you do that, and the share price sort of suffered, and we used that as a bit of an opportunity to jump in. But it's one of the only ones you've sort of got in that sort of space. So if you want to play this AI theme, yeah, it's very hard to get to sort of get exposure elsewhere, or certainly get sort of, especially to the quality end of it in terms of the companies that are really making money. And there's numerous reports out and estimates from different brokers sort of saying, well, look, if it wasn't for the AI spend, the US probably would be in recession at the moment. And so it's this part about going, well, yeah, I don't want to have, when Trump's doing weird stuff, you don't really want to have exposure to that, but you want to get exposure in those sectors. So that's one part. The other part is it is a bit of a global world, particularly in company investing, and there's a lot of companies that you can find a US do lots of stuff in the US or lots of stuff in Europe, but just happen to be listed elsewhere. And so, depending upon what you're trying to get exposure to, you can often get exposure to one country by investing actually in companies that are listed in a different country. And so, yeah, you just sort of, I certainly wouldn't, just because you're investing in Europe doesn't mean that you couldn't have a portfolio full of US exposure if you wanted to. There's lots of companies that'll get you that type of exposure.
And I'll make the point, it's interesting that the UK, the FTSE, actually did better than the US last year if you look at some of the movements, right? But of course, the FTSE, I'll just put this slide up. This is the FTSE. And you see it's moved up quite well. But of course, the FTSE is predominantly not UK companies, right? It's actually global companies. Right. So, it's a really important point to understand that whilst you might have an index based in a country, it doesn't mean that the stocks are actually in the country and are necessarily directly connected to the economic activity in the country.
Yeah, and even if they are in the country, there's one. If you just to take Australia as the example, BHP and Rio, it really doesn't matter what's happening in Australia. Most of their operations are offshore. Sorry, not most. They've got a lot of operations offshore. Both of them. They've got most of their costs are probably US dollar based, and all their revenues are US dollar based. And so, yeah, it's definitely. And I'd say the same thing with CSL. CSL's different in that it does have more manufacturing in Australia, but it's a global company that happens to be listed in Australia and head office. And you can sort of go through a list of a bunch of other ones: James Hardie, Brambles, lots of companies in Australia are just global companies that happen to be listed here.
Now, the other angle on this, just before we move off the Venezuela story, is this little angle here. This is actually from the ABC. Donald Trump's other goal in the Venezuela strike was to get China out of Latin America. I think it's worth just pausing to think about this, because there was a very interesting photograph published just a couple of days before with the president then of Venezuela with a number of Chinese delegates in the capital city just before it was invaded, effectively. And so again, it comes back to this idea of, the US wants to be in pole position, and it wants to effectively try and run interference to stop some of its other competitors on this sort of sphere of influence play getting ground, making effectively an entry into this idea of the Americas being, no, this is mine, get away, sort of thing. Do you think that's a significant element in all of this? And does it change again the investment thought? I'm thinking also of China, Australia. China connected to Australia very strongly through trade. If Trump is saying, yeah, exactly, and we were in the which area of the world is Australia in?
Yeah.
Are people carving up the world into big chunks and saying,
spheres of
I'll have
influence?
this spheres. You can have that, but I'll have this.
Yeah, well, look, I hope not, but it is potential, and I think the one that's probably more concerning from an investment point from me is that when you talk to people that are sort of involved in the government end of and a lot of the the think tanks and the people giving advice in terms of the to the US leadership, is that their ranks have been decimated. And I think there's an issue you've got in terms of we've got three major leaders in Putin, Xi, and Trump. All of them have built a lot of yes men around their own decision making.
Yeah.
And so and I think where the US had quite deep diplomatic core, and and if you said, okay, what's the game they're playing? Are they thinking 10, 20, 30 moves ahead? You'd be like, yeah, they probably are, or at least they're giving that advice to the president. Whereas I don't think that's the case with Trump. I think I think he's thinking one or two moves, and he's very happy, pleased with himself when he thinks three moves in front. But he'll usually tell the press that he's thinking three moves in front anyway, and undo that. And so that's the concern I have, is that yeah, it's clear that he's he likes to push limits, and he's certainly been pushing the limits of what's available to a president to do, but and what he needs Congress for and what he doesn't. He's been pushing that consistently during his term, and now it looks like he's decided that maybe he can push those same limits militarily. And is it a distraction from more Epstein stuff or whatever it is, just from something else? Maybe, but I think it's that concern that you certainly need to have as an investor, that look, it's more volatile and less predictable, and there could be you just don't know what's going to appear from it.
Yeah.
That was one part. And actually, I did have there's an interesting point as well on the whole Venezuelan oil one. Like, so their production's down 80% in terms of what they've done. So they've got these massive reserves. It's going to take years, decades to get it back up and running. So this is not a quick fix for the oil price, and it's the same. The type of oil is not the type of oil you can just put straight into refineries. It needs to be blended, or you need to build refineries just for that type of oil. And so there's lots of, this is not we just go turn the taps back on and everything will be fine. But, most of the problems came because the government basically said, "Oh no, we're better at doing all this. We're gonna run this, and we're gonna kick out all these foreign companies, and let's let our own management skills run this." And that's why you've seen it fall 80% in terms of production. The Trump, while one of the things you'd certainly say is he hasn't been good at execution, in terms of his, regardless of what you think about his policies, but the actual execution of them within the US has not been one of his strong points. And so I sort of feel as if handing over to him and saying, yeah, fine, fix the oil stuff. There's a weird sort of one government decided it could run the whole thing better than the companies, and so it decided to do it. And now Trump's sort of saying, no, we can run that whole country better than the company than that government. So, I think allowing governments to too much executive power, I think, is that danger that you see from this. You give too much power to one person, and drive the policy and make investments like we saw with Intel and other things like that, where it's actually them deciding, no, we're giving this money to this company because we like them, or they've paid the right bribes, or being obsequious enough, or whatever it is. Never works out well in the long term.
No, absolutely, and it is, short term, long term. How does it play out? I would remind people that some of the American forays into oil states in the Middle East worked out really well, didn't it? Not, and there are other states in South America that Trump has been talking about. Cuba and a couple of others, Colombia, I think, as well. So, is this the start of something or the end of something? The other interesting observation, just on the Venezuelan situation, is that he's sort of backing the deputy to basically, take over, and she was sworn in overnight. That doesn't mean that the regime necessarily is significantly different. So he's holding a threat, but what does it mean?
I know. And from a not that the laws matter that much, in terms of when governments want to do stuff, governments want to do stuff. But from a legal perspective, in the US, basically, look, you can do this type of thing, but you can't do it to a leader of a country. And so the argument that we saw from Maduro when it appeared in his court was basically, well, I'm the leader of the country, you're not allowed to do this to me. And the US argument is, well, yeah, but you didn't really win the election freely and fairly, and it probably went to this other guy and all that. And that is quite possibly true. But that's not the reason to put the deputy in. It's like saying, well, this guy didn't win the election fairly, so we're allowed to come in and take him.
Yes.
But now we've just installed the deputy who didn't win the election either. And so, anyway, I don't think contradictions that sense are matter to Trump, but I do think that's where they're going to run into legal problems at some point. And this is exactly what you're saying about the Supreme Court. What does the Supreme Court push back on, and what don't they push back on?
Yeah.
Because you can either, you can certainly run the courts at the lower end of all sort of, largely at the US, have stood up for the Constitution and the things that are the norms. And they've largely been knocked back at the Supreme Court level. And so you would think at some point they'll draw the line. And it seemed like the Supreme Court, the head of the Supreme Court in the US, Roberts, he had his year-end letter, and that seemed to be sort of suggesting, certainly there's a sort of an optimist reading between the lines, suggested that it's getting close to the point where they do need to push back on making sure that there are constitutional things that keep getting upheld rather than reversed. But there's a couple of interesting areas to watch in terms of that.
And just three quick final points here. They're all connected. The first is China Belt and Road. Of course, China has actually been very much engaged in spreading its influence through the Belt and Road initiatives. And in fact, Venezuela was one of them, as many others too. So by tearing up some of those agreements, potentially that could actually derail the broader relationships through Belt and Road. And it's interesting that China came out very recently and underscored the importance of legal agreements and the law and all of those things, trying to protect its position with regards to its massive Belt and Road investment. The second point is that, of course, the heavy oil in Venezuela is quite akin to that out of Canada. And bearing in mind some of the shenanigans between Canada and the US with regard to trade, in a way, you could say, well, the Venezuelan oil could be a replacement for the Canadian oil, which would be quite interesting. And the third point, just to round it out, of course, the opposition party, the lady who got the Peace Prize instead of Trump, might have actually been in a stronger position had it not been for the fact that she got the Peace Prize in the first place. So it shows you there's a little bit of a fickleness going on here, and everything is basically a bit up in the air. So when you sort of come to the end of the story, nobody knows how this is going to play out, right? But it does, for me, raise some questions about alternative market opportunities, precious metals, all of those things, alternative geographies, not just the US, and trying to sort of separate signal from noise, which is complicated and difficult given the fact that there are so many contravailing things. And of course, the Supreme Court tariff thing is not yet clear, right? They haven't come back yet on the resolution as to
No.
whether tariffs are
And
illegal in
look,
the first place.
yeah, well, I'll tell you what I think will happen with that. And it's, look, nobody knows with these. Obviously, the Supreme Court's been mercurial to say the least. But um, they'll either won't draw a line here. They'll just say, okay, no, Trump, you can do whatever you want. Which I think there's potential there, but I don't know. It doesn't seem that likely to me that they'll go down that path. They could go down the path of saying, no, these are all illegal, and so yep, it should have all been Congress, and we're reversing them. And you got to pay all the money back. I don't think that's likely either. I think that's the other end of the side. I think what you'll probably find is there's some part in the middle where there'll be, well, no, you shouldn't have been able to do this. But we didn't knock it back at the time. We actually it came to the Supreme Court and they delayed it or whatever. So you've got until whatever time to put it to get Congress to sign off on it, and you don't have to pay back. And then you can't, after that time frame, you can't charge them because there's a bunch of hedge funds out buying up the liabilities. Sorry, I guess theoretically the assets, so to speak, in terms of saying, okay, Martin,
the future cash flow is coming in, right?
yeah. So they're basically, I think it trades about 20 cents in the dollar.
Yeah,
So basically,
yeah.
you go, Martin, you spent $1 million on tariffs.
Yep.
I'll give you 200,000 for it. But if it goes to court and it goes to the Supreme Court and gets reversed, I'm getting the million. You're not getting the million. And so, yeah. Anyway, so and that probably gives you an idea of what effectively the weighted average expectation from people about how much what's going to happen with tariffs
Yeah.
is that now there's probably only a 20 or 30% chance they get reversed and they've got to pay all the money back. But I don't think that means there's an 80% chance or 70 or 80% chance they'll stay as they are. I think that's probably similar proportion on the other side. And the 50% chance is that, look, it'll be some sort of, okay, you shouldn't have done it, but here's what you got to do now. Go and get approval. Yeah. And then it's sort of, then he can go back and see what happens from there with the courts.
Well,
with the House and the Senate.
Well, let's segue on to talk a little bit about AI and energy, right? Because there's a really interesting.
Yep. Actually, yes. Sorry, just one quick thing before. Sorry, I just because you had those 3 points. The one thing with the China laws, I was smiling a little bit as you said that. I think China they like the laws when they're there and when they're in their favor.
Yeah.
I mean, we remember from the financial crisis when they were more than willing to tear up, anything that they had in terms of contracts to buy things and whatever it was. I think there's but as you said from that, this is not atypical. Like countries do this to other countries. Yes, the law says we should do this, but we're not going to do it. And if you're big enough and you have nuclear weapons and you have a veto at the UN, well, who's going to stop you? The thing is, I think the US, at least in the past when they've done it, they've couched it in a terms of, oh, we're doing this for the best interest of the local people or whatever it is, whatever they've couched it into some sort of story that sounded like it was vaguely noble, whether it was or it wasn't. Whereas, I think now it seems to be that sort of, one of the discussions about, what's different to this to what Xi or Putin might have done. Well, the difference is Xi or Putin would have tried to put some sort of spin on it to say, oh, well, we're just trying to help them, and they're these poor locals, and look how bad things are there, and we're just going to step in and help. Whereas he's just like, oh, we want the oil,
That's right. Made for television event. It's pretty
Yes.
amazing, isn't it? So as we sort of move the conversation forward, I wanted to touch on the AI story. I want to come at it just from this angle, though. There was a really interesting data point that I saw that China has twice as much power as the US. Installed electric generation capacity has skyrocketed since the 2000s. I think this is really interesting if you look at the US, China, and the EU. And to me, the AI story is morphing more and more to the energy story. And to my mind,
right.
This is how to attack and understand the AI trajectory from this point. And it comes back to a simple question. who's got the energy, how much is it going to cost, and what are the implications for the rest of the economy as more energy is thrown into the AI story.
Yeah. And what's really stark about that chart is where China has a benefit is that China has been growing their electricity infrastructure for the last 20 years. You can see that they've built an infrastructure that is designed to add more capacity to it. Now that's very different to the rest of the world, particularly US, Europe, Australia as well sits very much in this. And so the way all these work is that it's all about doing these big system studies into we're adding this new load. It's a data center, it's a factory, it's whatever, it's a some sort of processing plant, whatever it is going to be sucking power out of it. Now we're looking at adding wind farms or adding a new coal-fired power plant or adding whatever it is, nuclear if you're in the right country. And there's all these studies about how's that going to affect it? How do we get the load balancing? How do we make sure that it doesn't go down? And the problem with that is that it's not made for speed. It's made to slow things down. And effectively what you're getting now is now you're finding that you've basically got gridlock in the process. And I've got a chart I think that's well worth showing. So this is the Texas load requests versus approvals for 2025. And the blue line is the requests, the size of the requests. And the orange lines, which I'm pretty sure you can't see, but they're also got the numbers written on them in those, is what was actually approved in that time frame. So it's just and so companies are putting out multiple versions of this in terms of their uh, multiple requests. Part of this is not all those are real requests, and a lot of them are speculative. And it's people just saying, "Well, I'll put in this request, and if I get it, I'm not going to use it myself, but I'll sell it. There's all these people who want it, so I'll sell it to myself, sell it to somebody else." And so you've ended up in this. You're basically saying to the local centres now, they're all stuck in this position where they're not made to go and do thousands and thousands of these requests. They do like these quite deep studies they've got to do into how it all works. And they just can't do them fast enough to keep up. And by the time one of them is done, well, actually something else has come online, or there's other things that are out there. And so you start again and start doing another study on it. And so it's this sort of gold rush behavior that's sort of going on. And so there's actually more power waiting to be connected than the entire grid capacity at the moment. So yeah, I think there's, in a big sense, you've got this it's fundamentally against how it works in the US. You've got this move fast and break things data center IT guys wanting to come into this move as slow as you can, don't break anything ever. And so what's happening is the data centers are all starting to do this themselves. I think I saw a comment pop up there about data centers looking to do nuclear. That's not strictly true. There's some nuclear. They're happy to restart nuclear if they can and use nuclear. They're not putting in nuclear power plants and the issue is a nuclear power plant takes 10 years to come online if you're lucky, if you get it all right. The thing for these data center guys is they want it done now. They're and not and like every month that goes past where they haven't got the data center built, they're literally talking about billions of dollars they're losing if they could just get these up and running. And so that's creating issues all over the place. So there's a jet company that leases out secondhand jets, and they've stopped leasing out their secondhand jets to aircraft companies, and they're just taking the engines off, bolting the engines to the ground, and running that to run the power for the power plants. I've got these things up. I've got a picture up of just these trucks called solar turbines. It's basically already got nothing to do with solar. But you basically drive this thing up. It'll run your gas. You plug your gas in at one end, and it spits energy out at the other end. And you can just park that on your in your lot. You need a bunch of them, but the idea is that there's this real push on within the US is like they just need to build this stuff as fast as humanly possible. And so what does that mean? Well, it actually means a bunch of things. And in a big picture sense, you look and you go, Oh, looks, even if the sector tripled or quadrupled in its power uses, it really only needs a couple of percent per year growth in the total system because it's such a small part of the overall system. Yeah, it's growing really quickly, but it's just not that big overall. The issue is the speed they're trying to do it. And so what does that mean? Well, it means that I think there's going to be some flow-on effects you're just not expecting. So the you'll see that what you'll find is aircraft or airline tickets over the next 5 or 10 years might be more expensive. Maybe not right now, but they'll progressively get more expensive because the jet engine guys, they can build the jets fast enough, but the engines have already been bought by all these data centers to plug in to get the power. Um, there's We've seen factories out there that the factory's all built ready to go. It's got this big power load coming in, and basically the data centers have said, well, we'll pay you basically more than what the factory's worth because we want the data. Give us that for the next 3 or 4 years. You go put yourself at the back of the queue where we are, and you can have that data. You have that when it's go, but I'll pay you hundreds of millions of dollars to get the power right now. And the factory owners are going, well, I'm going to make more out of selling my power rights than what I'm going to do the actual what I'm going to actually make from the factory. So maybe it is worth waiting another 3 years for it. And so there's those. There's all these transformers, the big sort of transformers you need to sort of step down the power. It means that there's housing developments out there that are like we built the housing development. The power lines are laid, the water's plugged in, everything's ready to go. We can start building houses, but actually we haven't got the transformers, so we can't sell there's going to be some supply issues in terms of that. If you've got a factory or you got a factory or a hospital or an industrial estate, it's the same transformers these guys want. And so that we're now looking at delays of 2 years rather than three to 6 months for a lot of this stuff. And so I think my initial thoughts was, yeah, they'll be fine. There's not that much power that's needed. But actually, there's going to be this squeeze for the next couple of years where it's not that there's other sectors that are going to feel the effect of it. And it's a lot of money. And the people building these gas turbines, they're not putting them out faster. Um, they're I've got this chart up just showing this is what happened in 2000 when this was a lot of the fracking boom sort of starting and deregulation in the US and Enron and all that type of stuff like that. So this is how much they were selling, the gas turbine guys were selling in the peak years. So 20,000 megawatts a year in the peak years, and now they're selling, a couple. Like they all went bust, not bust, but sorry, a bunch of them went bust. The ones that survived only sort of just made it through. They've seen volumes come down significantly. You're not going to go out there and build a factory. You're going to have to run for the next 30 years to make your money back just to try and get in for the next few years while these guys are doing it, because the solar plus batteries is really the key to these. Now it's more expensive at the moment, the solar plus batteries, but the costs coming down so quickly, and so from a green perspective, I actually think this is going to be 2 steps backwards because we're going to put in all this extra capacity, and they're going to be parking trucks that run gas and all that type of stuff in the US. Um, so you're going to put climate change back a step, but at the same time, it's going to accelerate the battery use because they're really useful within data centers. And so I think as long as data centers do slow down at some point, we haven't got 20 years of growth in data centers. It's really a 5 or 10 year push. I actually think there's building the capacity and everything like that that is going to accelerate the green push at some point, but we're going to take a steps back for, I don't know, 5 years maybe. And so maybe it's too optimistic to think there'll be a step forward, but there'll certainly be lots more green energy put on than what there was in a few years. The issue is there's just going to be more non-green energy put on as well at the same time. Yeah. So there's that. Nuclear, look, small modular reactors, yeah, maybe they'll work. It's sort of a little bit like uh, these engines. Yes, you can actually, you can use effectively the nuclear power that you could use to run a sub, for example, and to strap it to one of these things and run that. But actually, most of those are already spoken for. They don't build them that quickly, and so yeah, you're unlikely to get those out quickly. The small modular reactors, great. Yep, maybe in 5 years' time they'll be up and running. Maybe more. they seem to work well, would work well for these things, but these guys aren't caring about 5 years. They want them in tomorrow. They're not, they're not looking at this saying in 5 years' time they'll have connection to the grid. And actually, data centers work really well with the grid. Like in a big picture sense, data centers need like all this extra capacity. They need all this either battery capacity or what do you call them, or generators in the background for redundancy. And that's fantastic if you get that on a grid, because the grid then gets to go, oh, can I use some of your batteries right now, or I can, you can actually, they get to actually act as a sort of balancing item on the grid when they're up and running and working properly. But eventually it's good for the grid, but yeah, it's this short term, 2 or 3 years, maybe up to 5 years, where there's just going to be real shortages in a number of areas. What's some of the other areas I had? I've got a bunch of ones here. This is yeah, you got local power issues, aviation, housing, hospitals, universities. They're exactly the types of high need sort of transformers that sort of work for these things. Manufacturing, you will probably have higher gas prices in the US, but I do think I think there's other things going on in the US is actually going to make more difference, which is all the building of the LNG plants and things like that. I think I saw a comment about water rights. Look, I'm not saying water isn't an issue. It is an issue, but because they do use it for cooling, but I think it's very localized. Uh, you know, if I compared the water used in putting a cement plant in or something like that relative to the data center, is actually there's lots more industrial uses that use way more water than what we're talking about for these data centers. But yeah, will there be some local issues? Yeah, absolutely. Um, and then the crypto stuff where AI companies are buying crypto mining sites so that they can put in their because they've already got the power. And so maybe there's a crypto thing there happening in terms of less crypto mining because the power costs, or they're being bid out for the power that they needed to run that. So yeah, lots of other little industries that are affected.
And just to give you a couple of other interesting examples, of course, the memory story is actually becoming very significant too. And there's a firm been around actually as part of Western Digital for years, but then was split out, SanDisk, and it was brought back into the market relatively recently. This is their stock price, right? And it's gone up significantly. It's regarded by some as one of the most interesting stories because AI needs a lot of memory, and the memory that is now going into the AI is actually going away from ordinary compute. If you want to get a PC built with ordinary memory, it's taking more time and cost because everyone's now focusing on chucking the memory components of the AI system too.
Yeah, yeah. Let me just I'm gonna pull up something. I'm just going to remember what do I call them? The company name. Oh God. Um, Micron is the one I was thinking of. That's the one. So Micron is I use this as one of my classic cyclical companies. I just want to grab their uh,
I can put the chart up meantime. There you go.
yeah, that's it. Yeah, that's it. I just want to show you I'll bring up a chart I'll show you the chart of the earnings forecasts, which is this bottom section. And it just goes from wildly profitable to wildly unprofitable from year to year as you go through it. So yeah, it's one of those fascinating ones where um and I guess my point with this one, when you're looking at these companies, particularly these ones like SanDisk and things like that, you can look at them at peak of cycle. Like Micron routinely trades at these top of the cycle. It'll be on like 5 times price to earnings or 3 times price to earnings. And you're like, wow, I just need to own this company for 3 years and I'll get all my money back just from the earnings.
Mm.
And then the next thing, bam, it's back into a loss. And then, the thing is it's like we sort of talk about it being like it's like a resource company. You buy it when it's on an expensive PE and you sell it when it's on a cheap PE. And it's sort of the reverse of what you think, not because you're trying to do it you're not trying to do it from a reverse valuation sense, but you're basically saying, well, when people are looking at it and they're paying 3 times earnings, is because they know this cycle's about to end and the earnings are about to fall off a cliff. And so that's where, within these sectors, and I think that's I'd highlight that very much so as you look through all these ones. You look through any of the companies involved in it, and you just got to go, what do these guys really have, and what's their baseline of energy? So we'll look at something a company like Micron, and we'll average its earnings over longer periods of time, and then say, okay, well, there's a couple of ways you can value it. You can value it on this year's earnings, you can value it on next year's earnings, you can do sort of these inflation adjusted longer term ones. And these are the types of companies where those inflation adjusted longer term ones work well because you get into these, let's say it's a jet engine manufacturer, and you go, well, yeah, they get to sell their jet engines for three times the price for a couple of years, but then their earnings will come back at some point because they're not going to run these things off jet engines forever, but they might for a couple of years just because they just need the speed and they just need to get it up and running. And so, yeah, there's sort of this. Whenever you're looking at these companies that are going into these boom areas and making profits, you just got to go, how sustainable are those profits in the longer term? Now, I'd sort of argue someone like an Nvidia, it's certainly making some boom profits and overcharging for what it's got because there are shortages, but it is also, some of the constraints are actually at the data center level as well. And so there's a certain extent where as well, we can't build the data center, so we can't actually buy the stuff we want. And so Nvidia can't charge, just anything for this stuff. And so I do think there's probably a bit more element in that in terms of saying there's some more sustainability. They won't be able to make as high profits. But then you look at ones where, there's a couple of others on our radar. One that I use on my radar where I look at it because uh, they do all the pre-work, laying down slabs and doing all the putting in the electrical and all that type of stuff before the data centers actually go up. So they're a great sort of lead indicator on these data centers. And the price that they're charging is just tripled or quadrupled. But in the end, you're like, what do these guys really do? They lay some slabs and put in some data connections and some water and stuff like that. The only reason they get to charge a lot is because everyone wants it done really quickly and everyone wants to make sure it gets done right. You don't want to just get some guy who's never done it before. You want to get somebody who's already done 50 of these to do it. And so they get to charge triple. But in a few years' time, they won't get to charge triple because the reality is all they're doing is sticking in a slab and there'll be all these other people who came out because I couldn't get the guy I really wanted, so I did have to find somebody who'd done a few industrial estates, and I used him instead. And you know what? He stuffed up the first one and he fixed, but he had 10 of them and eventually got it right, and now he's a competitor to this company. And then the prices all get driven back down and probably below where they were. So yeah, so it's very much going, okay, which are the companies here that are just really charging monopoly profits, and which are the ones that have genuine long-term business models? And so that's a real key for us in terms of how we assess this.
And it's interesting because if you read the various talking heads on the markets next year, they're all very much based on two propositions. The first proposition
This year
is
now,
this year. Sorry, yeah,
26.
I know. Can you believe it? What happened? I remember last year just. But they're sort of saying, well, in some cases there's still significant momentum in certain elements within the AI story, but not uniformly. But the other story has been a rotation away from technology, rotation away from AI into other areas of the markets that are potentially, a little more attractive. Now, in the context of that, Jason asked Damien, have you got an opinion as to whether Trump's decision about NVIDIA's H200 chips to China, does it make sense? Is it either commercially or national security risk? Because there's an issue here about policy, in the intersection of policy and the AI story, and Trump going right back to where we came into the conversation earlier on, right? As well as part of this confusion about, do you rotate? Do you not rotate?
So I think what I've said in the past on this is that to me, China's a bit of an upside for Nvidia in that they really don't sell much at all there at the moment. So if anything, they'll sort of, it's more. I think the problem I think they've done at least two deals, maybe three deals to sell these chips into it. The problem with Trump's deals is that it's a headline, and so he does the deal, and then it's like, well, okay, great, we're about to do this. Can we confirm what the specs and whatever it is? And it's like, well, no, he's already moved on. He's off. Just displacing leaders of foreign countries or creating tariffs or whatever it is. No, he hasn't got time to deal with it. And actually, there's nobody else in the administration who have with the depth of knowledge. And like when you look at other ones, this is a whole build-up. of like, yes, we're building up to doing this. We've got all these experts. They're defining it. They're making, they're working out where does this sit, where does that sit, and and then you get the deal, and off they go and they start doing it. Whereas Trump announces the deal, everyone then goes, well, the deal's to do this, and no, that wasn't what he hasn't written down all the details, so we don't actually know what it is, and so yeah, so we've seen at least two announcements that they're going to sell it. The issue is, will it ever get done? I don't know. That's one. The second part is, I do think it is in America's best interest to sell some of the older chips to China, insofar as if you don't sell anything to China, then they create their own industry because they're in the same bit. They want to do it as fast as possible as well. Now they're already trying to create their own industry. That's going to be that's going to happen anyway. Um, but the chips move pretty fast. There's a lot of I think it's one thing to say, yeah, we're going to go from being a really poor cement manufacturer or steel manufacturer back in the early 2000s, and then by 2020, we're one of the best in the world at doing this, and our quality is way better and all that type of stuff like that, because the technology frontier is pretty static. It's not moving very quickly, whereas these ones, the technology frontier is moving quite quickly, and it's hard to see them catching that technology frontier. But if you don't give them any chance, then they're going to have to devote all their resources to that. Whereas if you're going, okay, we'll give them some of the older chips that'll actually keep them happy enough that they can focus on, you know, China can't do everything, but they can then go, okay, we can now focus on more things to do. Now we're trying to go further up the tech stack, or we're trying to, spend more money on the actual processing itself, or the actual AI, rather than spending money just on the chips. And so, yeah, so I think it would be beneficial for the US to at least allow some of them. Yeah, and so there is some upside. I just don't know if it'll ever happen, because but I think it'll be announced lots of times. We've had at least twice already, and probably be a dozen more times before.
Yeah, very interesting. And of course, the other interesting announcement, NVIDIA overnight announced that they're actually putting some new chips out specifically in the context of driving automation. And I think that's with the relationship with a German car manufacturer. And so they're now throwing that into the mix as well. So they're trying to sort of go over here and over there and over there, which it's
Google took a bit of a leg up on them as
well. That's very true. But I guess one of the questions I've got, thinking about the amount of capex that's being spent and is planned to be spent, is huge, right? On stuff that is going to probably not be that enduring in terms of, when do those chips become obsolete? When do you have to replace the chips you got with new ones, right? The cycle is probably going to get shorter and shorter. So the thing I'm not sure that a lot of people have got their head around yet is, what is the implication on depreciation, and how depreciation flows into this, both in terms of future expenditure, but also in terms of share price and profitability.
Yeah. So actually, can I just show this chart? This is the expectations on the top lines, so the accelerated demand scenario, but it's probably the things are relatively similar. So it's basically going, look, over 25 to 2030, it's about $8 trillion spent on this. Of that, 2.5 is the data center infrastructure, 0.6 is the power. So as you can see, the power is not nothing, but it's pretty small overall, which is why if they have to pay 3 times as much for power, fine, because they're still making money on this. And so you can see that IT equipment is at 4.7 in the middle. So it's more than half, 60%, call it, of his spend. Now, not all of that equipment is NVIDIA chips, but most of it is. Like there's a lot of stuff that goes into, all your routers and servers and, connecting equipment and all that type of stuff like that. A lot of that, though, is, it's just not charging a premium price whereas these chips are really charging the premium price for it. So that's one part of it. So I do think the data center stuff, that's enduring, and the power stuff is enduring. That'll be around for, decades in terms of that. The IT equipment, look, my guess is that well, what I'm looking at, and certainly so Michael Burry, the famed hedge fund guy from The Big Short, he's he's talking about it being 3 years for this equipment. Now, there's chips out there at the moment. I don't think I've got one handy, but there's chips out there at the moment that are 5 years old, that are still selling you can still buy them today at quite, you know, not depreciated that much from there. So it might be down maybe 60 or 70% from the original purchase price. But given it's 5 years old, you can buy them and still rent them out and make money on it. So is that just a factor of where we are in the cycle? Maybe. I think at some point this cycle could turn, but it does look to me as if the equipment that's going in is going to last, you know, 5 years would be my guess. A lot of the companies are depreciating at five. Some are talking about it could be 6 or 7. I think a lot of it probably could run for 6 or 7, and you still make money from it. It just gets sort of downgraded and pushed, and you do less and less tasks. What I suspect is partly driving this, though, is that because we've got this data center shortage, the issue is not as much the chips. It's basically going, okay, so I have this data center that's built, it's got the power. Now, the chips in there, I could run it for another 3 more years and profitably run it, and I'll make whatever, $100 million from doing that. But actually, if I rip those chips out and put the latest ones in, I could actually make $500 million
Mm.
from it. Now, it's sort of the equivalent of, it's not depreciating it because it's now reached its end of its useful life. It's more because it's actually the scarce resource right now is the data center and the power to run this thing. And so, yes, I'll rip the chips out before they've depreciated, but not because they're not worth anything. It's just that it's the opportunity cost of not using it. And so I think that's the so yeah, so it's sort of it's true in some ways, but it's largely not true in most ways that matter. I think for these is that I think the companies can genuinely profitably run those chips for much longer. And the issue though is that they've got a better use for that property at the moment. And I can't see how that's a bad thing for Nvidia. Like either way is like, well, if the chips are still running after 5 years and they're profitable, fine. That's good for Nvidia because it shows that they can last and all that type of stuff like that. And if people are ripping out perfectly good chips in order to put in the latest and greatest ones because there's such a demand and everything like that, well, that's a good thing for them as well. I mean, it's not to say that the earnings they're making right now they'll make forever, but you're still seeing significant upgrades. Like, it's just one of those interesting ones where, just over the last month since I last spoke to you, Nvidia's forward earnings are up 3 or 4% because they've got growth rates of like 30 something percent in there. And so every month that goes past, their earnings, you look at their PEs, and if the share price hasn't moved, well, it's now 3% cheaper than what it used to be because the earnings have moved. And so, yeah, I think the one thing I don't know how much I spoke about this last time. A few months ago we basically took the view. Look, we like that sector. When we're in the AI sector, we want to be in the profitable part, the part that's really making money. There's some unprofitable stuff we sort of dabble with, but the profitable stuff that's really making this money, that's sort of the best part. But you probably should hedge what you're doing in that. And the hedging in terms of saying, look, if Nvidia loses its crown, who's it going to lose to? And there's basically three big ones you could lose out to. AWS has got, so Amazon's got some chips out there called Trainium models that they're throwing lots of money at. They're not particularly good relative to the Nvidia ones, but they're on the radar, and AWS is big enough and got a big enough R&D budget and got it captured at their own captured audience. They can put it through. Google, which then just came out last month, and they're starting to sell some of their specialist chips to other players out there. And so that's sort of one another upside. And the last one's AMD. And so AMD's sort of they're a long shot, more of a long shot, I think. But maybe they crack code and come up with something better. But there's that AMD part is they don't really have as much captured audience. So Google's got its own captured data center. So does AWS. Nvidia's got most of the rest of the market. Maybe AMD will do it, but They're your long shot. So there's something else I was going to mention on that. Oh, and so the next step, which is sort of the interesting part for the for the power use, is that there is a number of ones out there that are looking at using lasers instead of the electronics to do this, and it the GPU calculations are actually relatively well suited to how the lasers work, relative to something else. And so, could you see stuff like that in 5 years' time? Yeah, you could. I don't think it's imminent, but that's a potential that you'll see that technology. Yeah, but 5 years is probably too aggressive, but it's possible. Um, and that if that comes out, they use exponentially less power because, and that's the whole benefit of it. It doesn't need to be electric anymore. And so all of a sudden, maybe this whole power problem goes away in a few years' time. And I think that's what I was talking about in terms of how you look at, that the chip ones is one thing. Can they endure? They've got these big R&D budgets. They're working on these. They're all working on their own versions of it. But the guys that are just laying slabs and that type of stuff, they're the ones who, when the cycle turns, are going to lose out quickly.
Yeah, absolutely. And it's worth highlighting, of course, quantum computing is coming over the horizon too, which is another significant step, rather than what we've got at the moment. Lower energy
Yeah.
and a lot more power as well. Now, how that's going to play out, nobody quite knows yet, but there are people now talking about that as another shadow there down the road, which may again
Yeah.
change this landscape significantly.
This one. Yeah, that's right. And that's been there for a
Mm.
while. Look. I hope it comes good, the quantum one. I feel it feels a little bit like nuclear fusion. Like it sort of feels like it's or fusion. Yeah, fusion technologies, not fission. Yeah. Um, where it sort of feels like it's been yeah. I think I've just seen Jason's comment saying fusion within 5 years. I feel like I read something in 1980 that
Yes,
said
I
something
remember.
similar. I think there
Yes,
was a National Geographic article or something like
Nirvana's
that, and it was
coming
like,
over the
how
hill.
great is this going to be? And yeah, here we are, a significant number of years later without that there. And so I think there's that. Keeping an eye on those types of technologies is worth it. But I think there's certainly plans to reduce the energy usage. The
Mm,
question is just, I think at the moment, like a lot of these chips, they're coming out with a significantly less energy intensive, but they'll just pack more of them in there. They're basically like, okay, we've built our data center. If we can pack more in, we'll pack more in. And
mm,
so,
mm.
yeah.
Now, the other angle here, just as the capital recycling. So, Damien got this from Jason a little while ago. Do you think that OpenAI will succeed or crash given the losses it's running? Will the partnership with NVIDIA work and save it, or will it fail if it continues? And that's sort of the question, isn't it? Because we have the situation where we've got these big players with big capital budgets investing in a lot of other players who are making significant losses at the moment. And, there's a bit of recycling going on. I remember in the previous show, I showed you some of these relationships between these different
Yeah.
players. Trying to unpick that is complex.
Yeah. Look, OpenAI, it's a tough one. Uh, Look, they were, they're the leader in a very fast-moving horse race, and well, sorry, they were the leader in a very fast-moving horse race by a couple of noses, and now they're behind by a couple of noses. Um, will the next version, can they jump in front again? Absolutely. I think there's lots of different issues around that. I think the amount they're spending is, or the amount they've committed to spend is, and actually when I say committed, sorry, the amount they've committed is probably the wrong word, maybe promised, or I don't know. There's sort of like, put it in some inverted commas because it's that it's far in excess of what they're making in any way in these revenues. And so if that was the only thing underpinning this whole AI boom, then I'd be like, well, yeah, there's problems coming for all of these others. But the issue at the moment isn't so much that if they imploded and is like, uh, yeah, it might be a bad thing for Oracle and a few of these other ones that are set up. Let's say OpenAI falls to like fifth or sixth in line. They just don't keep up. Their next few versions are terrible and all that type of stuff. Is that my expectation would be Oracle will go, okay, well, you're not going to you're not going to be able to use these data centers that we're already building for you, and there'll be three or four other companies will turn around and go, "Oh, you've got extra capacity? We'll take it. We're done." It's there's that much demand out there at the moment. So I mean, if the AI sector itself runs into this whole problem where the whole sector then goes, actually, no, the spending's not worth it. The boards are pulling funding, where the whole thing turns, and that happens. Yeah, okay, now we've got problems. But if it's just a matter of saying, well, if it's not open AI, it's going to be Anthropic, or if it's not Anthropic, it's going to be Google. And if it's not Google, it's going to be Grok and Tesla or whatever. I guess that's the major part for all the downstream ones. Does it concern me when I start seeing those circular deals? Absolutely. It's reminiscent of what we saw, in a bigger way in the whole tech boom, where effectively companies would raise money from private investors without any expectation of ever making a profit, and then turn around and give that money to other internet companies who would then buy products from the first ones. And so there was just this whole circular money was coming in from outside investors and being put into these things, and without real business models and everything like that behind it. I think the difference for me for AI is most of this, there's definitely some ones out there that are loss making and concerning, but most of the guys are making significant money. And of the ones you look at, you say, well, let's use Google as the example, is going, well, they're effectively selling you ads right now on YouTube, as you're watching this probably, taking that money and using it to go build data centers in the US. And so they've got that money. And now you say, oh, yeah, but Google could stop. And it's like, well, yeah, they could stop. But if Google falls behind in this race, they're probably losing. They're probably not a company anymore. Like the whole search, the whole search sort of underpins their business. It's an existential thing for them. They genuinely have to spend that money. Otherwise they might not be there. And then you go, okay, who else is spending money? Well, Microsoft's out there spending this money. Is Microsoft in the same boat? Probably. If they're not up to speed with what's happening with AI and incorporating it into all their products, they're probably not a company in a few years' time. So they're going to keep spending. Amazon, well, yeah, that's tick the box again. That's what they do. The AWS. So you sort of go through those ones and you go, you need, a lot of them have this existential issue about they can't stop spending money because they might not be a company in 10 years' time if they get it wrong. If they decide, no, AI is a crock, I'm going to go it, I'm just going to do what I was always doing. And so, yeah, you'll need some sort of event and a shift in expectations for that to change. That the ones I speak to, even the companies I speak to that don't like the AI and whinge about the amount of money they're spending on it, are still spending more next year than what they spent this year. So the ones that are like, oh no, we spent all this money in 2025 and we got nothing from it, and the guys put in this stuff and it's terrible and productivity hasn't changed and it's not usable and it gives us dud answers and all that. It's like, oh, okay, so you're going to stop money spending? No, we're going to spending more money this year. We've got it. Everyone else is doing it. We're just worried that if you're I don't know, a grocery store. You're selling retail, and you're worried that if you're not, I'm not spending AI on identifying with cameras all the stuff. Then in 3 years' time, all my competitors they'll have fired half their staff, and they'll be charging less than me, and I'll be behind the eight ball, and I'm going to there's all this. And I'll be fired as a manager. I'll be fired for somebody who'll come in and put it all in. So, I just think there's the worm will turn at some point, but it just doesn't look like close to turning at the moment. And so, I think keep an eye on it. But I think there's things you can be worried about, but staying invested. And I think that's where it comes back to, I guess, what Trump's doing is like, look, I am really worried about stuff that's going on. I am really worried about this AI whole thing could all turn and stuff like that. But it's not just yet. And until you can see the clear signs, because if you sold at every sign of danger, you'd never be invested. There's always something going wrong. There's times where it's heightened, and you say, and you're much closer to a cliff, and it chips over, and it gets very dangerous. And so you need to be more wary at those points. But there's lots of times the market will skate close to the cliff, and then off it goes again. And if you sold every time, you'd lose out.
It's interesting. We had a couple of interesting conversations going on in the chat as you were talking there relating to TSMC. So Bill said, all advanced chips rely on TSMC. What are the risks? And
Yes.
again, TSMC, AMD, Nvidia, they're all Taiwan related.
Yep.
And goes right back to our first conversation when we started today, on the on the global risk and who's got power and everything
Yeah.
else. Taiwan, rather close to China. The exercise is just running recently between China and Taiwan, and threatening the TSMC story. If you look at the market at the moment, their prices are significantly up from where they were. Um,
Mm.
it, too big a risk, or is this manageable as well?
It's a big risk. Yeah, TSMC. Look, TSMC. That's the interesting thing with Nvidia is, as you said, for anyone who's not aware, one of the real benefits for Nvidia, why they managed to grow as fast as they did, is they don't do the manufacturing. TSMC does all the manufacturing for it. Nvidia just does the design.
Mm.
And so effectively, what it was is that TSMC's got all these production lines set up, and basically Nvidia goes, hey, we've got this great selling chip, can you produce it for me? If they had to do it themselves, they're like, oh, now we've got to build factories and do all this stuff and set up quality control, and in 10 years time we'll have this great system set up to sell the chips. Whereas within TSMC, you're like, yeah, here's how you do it, let's get up and running in 6 months time. And TSMC is like, well, we're just going to push out. We've already got this capacity. If you're the one who's going to be selling all the chips and we're going to get better margins from it, we're pushing out somebody else. And so, yeah, their ability to do that is quite spectacular. But so a real risk. I'm going to talk about China in a minute and what the risk around that. But it's also worth noting that TSMC don't stand alone. TSMC is built on the back of hundreds and thousands of different companies, across part of the whole problems with these data plants. If you've ever seen any of these processes in these semiconductor plants, is that there might be 1,000 processes that go into each one. And you sort of go, well, if I had a 0.1% failure rate on every single one of them, by the end of 1,000 processes, I'm throwing away all my chips. I've got nothing left. Like the level of quality control you need, because you just keep doing that calculation of, 0.9999 times the next 0.9999. And so that, TSMC's got a lot of that thing, but they're not the whole world. They're using all these other companies within that. And that's very similar. I spoke about ASML. Is basically they're one of the only ones that can make the machines that TSMC then go and buy to put into it. But ASML are basically the same thing. They don't make most of their stuff. They've got all these they're effectively a manager of hundreds of other small companies. And there's a company that makes, mirrors that change by one atom across a meter or something like that. That's, the flattest mirrors ever. And they don't have the ability to do it all themselves. And I think that's the world we're in now, is that none of these companies can do everything themselves. They all rely on the global infrastructure and being able to trade with all these different companies. It's not the same as it used to be. And so it both makes it more stable and less stable in a way.
Mm.
So yeah, it's
One to watch.
so okay, so that was that.
Yeah.
Now China, look,
Yeah.
could China, if China stepped in and took over Taiwan, is it now in charge of this, and it can start turn around to the US and say, well, no, you know what? You can't have the chips anymore. We'll give you the dud chips. We'll take the good ones. No, I don't think they can. I think if you are in any way a senior executive the senior, sorry, not executive, technologists in TSMC and the research guys, you're unlikely to want to stay in a Taiwanese run, a Chinese run Taiwan. You're very likely to get paid very well to move to somewhere like the US. I suspect from unless they've managed to pay off, I guess, Donald, or convinced him that, yeah, they can take it themselves, I think there'd probably be a reasonable bit of sabotage in some of these plants. And these plants, they're sterile operating environments. You got to put the whole thing back together again. And I think if you're a country, if it's Taiwan putting it back together again, I think they absolutely could. I think if it's China coming in to try and put it back together again, they run into that problem of, half the engineers have disappeared. The ones that are left don't really know what the ones, and so, yeah, I think it would be problematic for them to expect to be able to step in and run the whole thing. And I think that's part of the reason why the US wouldn't end up giving um, a deal to say, the US will take Venezuela, you can have Taiwan is for that reason, is that, the US wouldn't want to be on the other end of that chain.
Yeah, very interesting. And I think one to watch. Something else to watch, of course, is precious metals. And just a
Mm.
couple of inputs there. Of course, we've got the central banks are their longest gold buying spree ever, pretty much, which is fascinating. And if you look
Yeah.
at the silver price, silver is up. Whoops, that's not silver anymore. Sorry, let me put silver back up.
Similar chart for silver, I think.
There you go.
Yes.
Yeah, that's the silver chart.
Yeah.
77, so very, very, very high peak there. So what's going on with precious metals? And is this a sign of, disconnection, concern? Why are we seeing this going on? What does it mean for investing again? I saw people in the chat saying stack silver, can't get into these fixed assets. How are you reading this out, Damien?
Yeah, look, I mean, this is a concern people have. Obviously, there's when you're worried about everything that's going on, is like, well, let's go to these hard assets. And what do you call hard assets? The problem I have with all these, in a big picture sense, is we're talking about speculative assets, and I
Mm,
think that's where, at least uh, with property, with stocks, there is a return that gets earned on those. And yes, you can go through these periods where the value gets disconnected, but in the end, if properties don't earn a rental return, and you look at some of the boom bust towns or whatever it is, where you've had a big mining boom come through a town and you built it all out, and rents went sky high, and then a few years later, the factory shut down or whatever it happens, and now rents fall by 70%. The property prices fall. Like, it's not they're tethered to what that money that comes through. In terms of stocks, it's the same part, in terms of, yeah, they can go through, manias, but eventually it has to come back to, you need to be making the money. They're tethered back to that. Like, there's a um, in terms of stocks, especially, there's effectively an infinite supply of stocks if people want to buy them at any price. There's plenty of people that go out and sell stocks to people. Like, you can just keep doing it. The benefit of these other assets is, oh, okay, now they're constrained. There's not as many of them. So, but there's no fundamental basis to it. Like, as I said, you can stack as much silver as you want. You're not making any money from it. It's only the fact that you're expecting somebody else will want to buy that stack for more, and that we can't produce silver fast enough, and so therefore, I'll be able to sell it at this higher prices. And so I think that's the part with all those assets, and cryptocurrencies sit in the same basket, and oh, sorry, Bitcoin sits in the same basket. I'll talk about cryptocurrencies more generally. Is that it's a bet on whether other people are going to want to buy it, and that chart you're showing there is exactly that. Central banks want to buy it, so therefore, you're right to get in before the central banks. And if you think central banks are going to keep buying it, then stay invested in it. And if you think other investors are going to want it, then this is a if other investors want it, then the prices go up, and then more investors want it, and so that's really been the story for gold. We're still relatively invested in gold, within our portfolios, uh, and I think, I do think there's a certain amount of that is people, central banks, including being more worried about the monetary system, and more worried about keeping assets in US dollars, and not really having a good alternative, and so going, well, let me dump more into precious metals, I think, is part of that whole part. So I think that'll be a great story until one day it isn't, and you just need to just know you're playing a game of musical chairs. It's Yeah, there's money. I do think there's money to be made in that. We're still invested, but when the music stops, you don't want to be in that. Whereas at least in stocks, you can sort of go, well, I can see that maybe the stocks have run up a bit, but fundamentally, there's a certain price I'll pay for these things, and you're getting on stocks. There's a lot of stocks out there you can easily get a 3-4% yield on. And you're saying, well, if I'm getting a 3 or 4% yield that's growing at well above the rate of inflation, then I can sort of look at that and go, well, that's my worst outcome, is I get that. Whereas you look at an asset like a Bitcoin, or a silver or gold, and you say, well, what's my worst outcome? It's like, well, the worst outcome is it just keeps going down because people don't want it anymore. And you went through some pretty long decades of that in the 80s. And so yeah, that's when central, as I said, on that chart, when all the central banks were selling, that was the time to be out of it, and wait till the central banks start getting back in, and that's the time to be owning it. Mm.
Yeah, and I think for me, this is a signal of the general levels of uncertainty, some of the international issues that we've been talking about. It's part of it too.
Mm.
People wanting to perhaps move away from the US dollar and looking at alternatives, at least in the short term. But remember, you don't get a coupon on gold
Yeah,
or
and
silver.
that was my point on crypto. I want to say on crypto as well is Bitcoin is pretty limited in terms of supply. Oh,
Mm,
well, it's limited in terms of supply.
mm.
Um, uh, Cryptocurrencies aren't though. That was where when all the shit coins and all
Yes.
that come out is like, yes, we can produce as many of these as you want. If people are prepared to buy them,
Mm,
plenty of people are prepared to sell them.
yes.
And so that's sort of that's a
It,
crypto itself as a whole asset class. I'm like, no, I don't think that can keep going up because there is a floor for that. But yeah, there's whether Bitcoin makes it through or not.
so, as we come to the end of the show, I just wanted to touch on the Aussie dollar because I think the
Mm.
Aussie dollar story is also quite interesting at the moment. There's the current chart, and you can see that we're up at 67.21 US cents at the moment, which is quite higher, a lot higher than it's
Mm.
been for the last year or so. And I've seen a number of people say, hey, this is amazing, strong dollar. Well, that says that the Aussie economy must be doing really well. I'm not sure that that's the full story. What do you think?
No, I think the sign is my read is that we've got a more of an inflation problem and less of a solution to it than most other
Yes,
countries.
exactly.
I think it's basically, yeah, we've mismanaged ourselves into an inflation problem. We've got large parts of the economy that are effectively immune to interest rates, insofar as when you're bringing in lots of people and they need to live somewhere, they've got to bid up house prices and rents. When you've got when you decided that you're going to let energy cartels do whatever they want, then we're going to be paying more for energy. We've got and then we're largely public service. We've got a pretty big public service there, and so and high minimum wages. Not saying either of those are a bad thing, but that just means their wages are going up at whatever rates have been discussed and decided.
Mm.
I think there's fewer and fewer parts of the Australian economy that are reliant on those inflation and yeah, sorry, are reliant on those interest rates to help. And the one place is property.
Yeah, and Madeline earlier on asked a little bit of a sort of connected question. Well, okay, if you don't want to invest in the US or China, you know, where do you invest?
Yeah, well, and so when I'm saying so what I was saying in mine is, look, we are invested in the US. We've got more in. Oh yeah, let me talk my portfolio at the moment
Yeah.
where we are. Um, so we're mostly invested in equities. We're still we're pretty close to like our benchmark levels, and so to speak, in terms of where we are through the cycle. Um, we are we're we've got less in the US and more in Europe. We've got a reasonable amount in gold. We don't have much in oil. Um, Within the stocks themselves, we've got a reasonable amount of AI exposure, but the profitable end of the AI ones I spoke about, your Nvidias and Microsofts and Google and Amazon and those ones. Um, there's some in the healthcare sector we've got exposure to. We've got a bit of an each way bet on Novo Nordisk and Eli Lilly, and Novo Nordisk has been the one falling off, and Eli Lilly's been the one taking off. And we're sort of like, oh, I feel a little bit the same with Nvidia, Google, and Amazon. It's like, well, I don't really mind. I think the whole sector's going up. Maybe one of them will lose market share, maybe the other one, but Um, Healthcare overall, we're actually a little bit underweight ex those companies. We just sort of we spoke about on it when we did this. For anyone who missed, our Martin and I did a 50-year look at, oh, so eight sort of long-term trends, and one of them was the rising obesity, which has stopped rising, and so effectively you had a sector which every year was like whatever it is, 0.7% more people are obese, and so that sort of just fed the whole healthcare industry. and maybe that's coming to an end. So I've sort of got some thoughts on that. What does that mean? There's actually a few. Went through some companies today just on this whole, what do people when people don't die because of heart disease, or they don't die because of cancer, or because we're getting better at treating these, or they don't die of leukemia, and you've got all these things we're getting better and better at treating it. What do they die of? And uh and so and what what's the and so some of the effects of dementia are sort of, and Alzheimer's are rising, and it might just be that they were always there, but we're just living long enough to see it. And so Eli Lilly's actually an interesting each way bet. They've got quite an interesting Alzheimer's drug out as well. Um, so yeah, there's a few of those bigger, longer term trends we're invested in. We're not big on consumers, and particularly in the US, not a lot of consumer exposure. We haven't got heaps of Australian exposure. Our view is the Australian market's expensive, low growth. Yeah, hard to see that much benefit from the AI boom on that. So that's been good over the last year. What else we
Financials?
invested in?
Financial
Financials,
sector?
no, underweight
No.
financials. Yeah, the problem in Australia is you're underweight financials, you're underweight resources, you got to be overweight everything else. There's just nothing left. That's it. You basically got three. Well, I call it four choices within
It's
Australia. You've got yeah, financials, resources. You've got your international stocks, which is or your James Hardie's and CSLs and all that type of stuff, which is really just international stocks happen to be listed here. And then you've got a couple of domestic ones, Woolworths and Coles and JB Hi-Fi's and those types of stuff. You really don't have very many just Australian focused companies. So yeah, yeah, that's sort of largely the portfolio. Oh, there was something else. Yeah, and then within the bonds, we've been largely in the short end of it in terms of just going, look, inflation's worries, long-term bond rates going up. We just want to be focused on that short end, and then at some point we'll flip back around. But yeah, just trying to avoid the longer-term bonds.
Absolutely.
So.
Uh, Jason asked this. I don't know whether it makes sense, but do you have OpenAI?
No, I only invest in listed companies.
Yes.
So we're top 1,500 globally is what we invest in. So the idea is I just want liquid assets within everything I'm doing. So none of them are sort of unlisted that you're sort of marking your own homework and all that type of stuff like that. And you want the ones where if things happen, people can go, yes, I know I can sell those if something happens. Other companies are good at doing all these other ones, but we've got a big enough universe just doing those large stocks that we're sort of pretty comfortable in terms of that. It's worth looking at that quant quake as well. It's probably worth just quickly run through that. So we do a reasonable amount of quantitative investing, but one more thing just to keep people up at night is this is just a chart of showing the quantitative funds and what happened, some of the biggest quantitative funds around there. And you can just see a couple of these, like so Renaissance, which is one of the biggest ones in the world, lost 15% one month and then made most of it back in the next month. There's a bunch of these other ones. Systemica lost, had a couple of really bad months in there while everyone else was making money. This is sort of what happened throughout 2025. And it's at least it's worth being aware that this is going on, and nobody really knows exactly what happened with it. Like effectively, similar things happened in 2007, just before the end of that sort of cycle. There's a couple of what they call quant quakes. I think 1987, the whole crash then to me was a lot of that was a sort of a quant quake. Everyone all in on the same strategy, and so there's sort of two sort of main theories out there as to why this might be happening. There's conspiracy theories. So maybe this is a sign, that the markets are just getting dislocated. There's this stuff goes on and things get weird like this, and then all of a sudden markets crash, and so maybe that's happening. There is certainly a crowding argument, and that's probably more what happened in 2007 and 1987. Is that basically everyone's all doing the same trades, and so they're all bidding up the same stocks, and so when those stocks do turn, everyone suffers at the same time. Now, that would be a nice sort of story if it wasn't the fact that that chart was showing all these ones doing different levels, and we've also got these are a bunch of different strategies. So sort of like trend following strategies have been done the worst. They're the ones that are just like momentum strategies, buy what's going up and sell what's going down. Some of the other ones actually did all right. So it's not every strategy that's going weird, but there's definitely a few. Like there was a what they call junk rallies. So a lot of the poor quality stocks, or at least the stocks that look poor quality from a traditional quant perspective, did really well some months and really badly in other months, and so that sort of made a lot of these things. But and then the other thing is maybe a lot of these guys are switching their processes and just using a lot more AI, and so they're just maybe this is just like one fund deciding that I'm getting out of this strategy and getting into a different strategy, and that's throwing out everyone else's returns. But I guess I just wanted to highlight that there's something weird going on in this market, and no one really knows what it is. And so, if you want to have something else to keep you up at late night, if you're not worried about Trump strikes and China invading Taiwan and all these other things we're talking about, or more inflation, yeah, there's one more thing to keep you up at nights.
Very interesting. I said at the start of this year, turbulence and volatility is going to haunt us through the next few months. And I think there's nothing that I've seen from this conversation or my other analysis that's changing my view. But that doesn't mean don't be invested. It means be invested carefully, right? Be invested in liquid things so that you can actually shift around when you need to. And also just pose to yourself the question, what if I'm wrong, right? Because there is little level of certainty about a lot at the moment, and I think that's something else people should bear in mind as they think about their investments and look at the tools that are available to help.
Yeah, and it's this thought. Let's say you're in retirement, you've got $1 million and it's invested, and you're like, well, what am I getting from that? Well, if I'm getting a $30,000, I've got $1 million invested, I'm getting $30,000 worth of dividends every year. That's growing. The worst sort of downturns, that maybe falls to 27,000 or something like that. Like it's still generating a return, and saying, well, is that a return that I'm prepared to take? And the dollar amount can go up and down, but if it's that dollar, and sort of similar in terms of thinking about it, your house, in terms of if you're renting out a house, if I'm getting that rent coming through, then am I happy with that? I need to make sure I'm still going to get that rent. And a house is probably slightly different in that you can be very individually exposed, but on the broad market, yeah, I'm pretty confident that the dividends, in bad downturns are down sort of 5% or 10%, in quite bad downturns, and bounce back pretty quickly. And saying, well, how long am I prepared to live with that type of return if I bought in stocks at various levels?
Absolutely. And I do think taking a longer term view and having a strategy is all part of the story, and having access to the right tools as we advocate on this channel. The tools that you offer are transparent, open, flexible, unlike some of the others that are out there. So folks, check them out.
Yeah. Thanks for the plug.
Well, I think it's important because I think these days people need to have, as good as information as they can, but also some flexibility. And I do think it makes a big difference. Damien, thank you so much. Very interesting conversation. We touched some very significant and prickly issues, and well done. I'll look forward to having you back on next month, and we'll continue to do this through the year as the year builds. And I'm sure we'll have other things to chat about then. So thank you very much.
Absolutely. Thanks, Martin.
Okay, I'll take you offline and close out the show. So there you go. I hope you found that interesting. Just thanks to Jason for the super chat. Really appreciate it, Jason. You're great in terms of helping to support the channel. So thank you very much for that. Greatly appreciate it. Just so next week I will be on, and I'll be looking at my latest analysis and looking at postcodes and those sorts of things. So join me for that. It should be an interesting conversation. I've got some new data that I want to share as well. And got some other guests planned ahead as well. So it'll be a busy year of Tuesday night live shows. Check out the recorded shows as well. And the doggies, yep, they're here. They are looking quite comfortable, although they came and gave me a nudge just now saying, oh, it's time for lunch. So that'll be my next task. But thank you very much for spending time with us tonight. Have a good evening. Keep cool over the next few days as the temperatures bubble away. And I'll look forward to seeing you live next week and also on the recorded shows. This is Martin North from Digital Finance Analytics signing off. Take care.